we were playing in recent months with the title here, is winter coming? Is it coming again? You know, related obviously to the corona, where it seemed like the winter, in particular investment climate winter, came in March, and then it sort of went away pretty quickly. But the question is, I think, relevant again. So that's a title. We'll also talk about the challenges and how to answer this challenge. So let's go to next page and next after that. So winter is coming is one of the key generational challenges for especially pension savers. Now, we will argue it's not just a question about bonds, it's really of all asset classes, and it's pretty much for every investor, but it might be particularly cold winter ahead for Swiss ones. And what can you do? The first thing I will say that let's accept it, let's communicate it properly to our constituents. But then there are some ways how we can try to keep warm, and I'll talk about those then. And then as a last topic related now to this COVID environment, how to protect yourself in a downturn, and there's some comparison on various protection strategies, trend following, puts, fixed income, some slides on this at the end. Okay, next. And next, please. Okay, so this is my typical starting slide, more than 100 years of data on expected real returns on major US asset classes, stocks and bonds at the top, and then 60-40 portfolio at the bottom. And at the bottom, we also look at the realized subsequent returns, so that we show that these expected returns are not, sorry, I got a phone calling here, that these expected returns are relevant for predicting future returns. Okay, and there are many ways of course, estimating expected returns. These are particularly simple ways, but using some yield-based data. So at the top, you can basically see 10-year treasury yield minus some measure of inflation expectations, and then S&P 500 real expected return based on some yield-based measures, Schiller PE inverted, and a simple dividend discount model. Okay, but the main message in this page is that all these lines are near all-time lows. And so at least from US perspective, looks like we have low expected returns and pretty much the lowest ever. And we'll talk about how this broadens when we look at other asset classes as well. Go to the next page, please. Okay, so this is most transparent in government bonds. But the danger then is that investors in other asset classes don't see that it's almost as important or as important for them. And why is it that we see everything expensive at the same time? It's really because every asset can be thought as priced as expected cash flows divided by a discount rate, which is basically riskless rate, and some premia. And we can debate what those premia are, and we can debate how high they are. But basically, when the common part of that discount rate is so low in pretty much all countries around the world, that makes everything expensive at the same time. And so that's where we have been for a long time, and that's where COVID probably has pushed us for even longer period now in the future. And again, this is a global challenge, but worse in Europe, related to the lower cash and bond yields here and larger bond allocations. I'll return to that in a moment. Next. Just to say that we've looked at many other asset classes, and I'll later return to private equity as one example. It's really even harder to estimate expected returns for that asset class. But we made a brave try on this in a recent publication, and you can just see some result on that in the green line, which basically shows expected real return on US private equity buyouts, basically. And it shows that there was a big gap and very high expected return sometime in the olden days, and much smaller gap in the last decade. I'll refer to the actual publication for more details. Okay, next. So I do think that while there's more and more discussion on this topic, it's still underappreciated outside bond markets, and partly because we have had this good tailwinds and high realized returns. like on the other hand, like I could say, I should really be humble because I've been telling this story for many years, and we have been seeing very high realized returns still in 2010s throughout, as it sort of rich things have been getting richer, and we say that the tailwinds, windfall gains that we saw in recent decades can't just continue forever, but so far they have continued. But I think there is some amount of payback time ahead, as we have been in some sense borrowing returns from the future. And we do not say that we know whether the low expected returns will materialize through slow pain, basically picking these very tiny coupons and dividends, or a fast pain, seeing mean reverting, rising bond yields and falling equity valuations. Either of those approaches will mean low expected returns for the next 5 to 10 years. Okay, and investors who look at just rear view mirror of 2010s or of recent decades will be overly optimistic and will be disappointed in most likely scenarios. Next page, please. Okay, and so on this Swiss perspective, I used in the earlier picture, and here too I put 5% real return line, and that's sort of maybe more relevant for a 60-40 type of portfolio. And US investors, Swiss investors may have more modest expectations, perhaps 2-3% real, but you also have got this very low bond yield, very low home cash rate, and that means that if you do currency hedged international investments, that's going to anchor them at the low end. I'll show a picture on that in a moment. And you have got larger bond allocations than typical Anglo-American investors. So we put here a shorter history, but sort of similar picture there at the bottom, where we have added a Swiss portfolio, 40-60 portfolio, so more bonds and basically the global equities and Swiss bonds. And you can see that this is a barely positive real return that could be expected. And I do know that most of you have got Swiss real estate, and I don't have the yield number for that, but I bet based on everything else that I see that there's low expected returns compared to history in that asset class as well. Okay, next. So now I'll show a couple of slides from our capital market assumptions. We published those always in the early year. We published them in January, and now we just updated them for the mid-year situation. Sort of wanted to get the pre and post-COVID comparisons, and you can see basically expected real returns over the next 5 to 10 years for various asset classes. And the two circles there show numbers at the beginning of the year and then a few weeks ago. And the whiskers around the second circle there basically show some kind of confidence or uncertainty band, just saying that these things, even for 10 years, they are really difficult to estimate. But with that caveat in mind now, then let's look at what these things say. They say something like 4 or 5% expected real returns on equities, and somewhat higher now after COVID. So equities are somewhat cheaper. When we look at bonds, we see lower expected returns, whether it's credits or govie bonds. And the biggest change actually has been in cash, where you can see that US cash has gone from mild negative to sort of Swiss type of minus 1.5% expected real return negative level. Okay, and so that's pretty much the big story that we see. I will give you much more detail in the next 2 pages, but I already say then that there are, so you can go to next page, please. There are caveats when we look at these types of estimates. The first slide in the appendix, where if you get the deck, will list various caveats that are especially relevant in now this COVID environment. On the other hand, we are talking of something like 5 to 10 year expected returns. So we don't think that very short-lived sort of V-shaped earnings drops would matter as much for these estimates. But let's just be particularly humble in this situation, because we don't know yet whether it's a V-shaped or U-shaped or whatever shaped situation where we are in. So far, there's been relatively modest impact. Okay, so how do you look at the 5 to 10 year expected returns on equities? I won't go into details. These are not quite as simple as the variants I showed earlier, where we just looked at things like Schiller earnings to price ratio and a very simple dividend discount model. We tried to refine this a few years ago, and we said that let's take a couple of different approaches, because there is no one correct way of doing this thing. And you can see an earnings-based estimate. Basically, well, any forward-looking estimate tends to start from this idea that you look at some yield income number, some cash flow growth number, and maybe changing valuations, often mean reverting valuations, so some expected repricing. And we have chosen to put this last one to 0, as have many others who make capital market assumptions. If you see some others who have got very, very bearish forecasts with near 0 expected returns on equities, you would say like GMO and RAFI, they tend to include that mean reverting valuations. And we just say that, okay, we get low expected returns already from the income part. We don't make it worse by assuming that there's going to be mean reverting valuations over the 5 to 10 year horizon in the future. It might come, but that would be sort of making the low expected return case even stronger. So in this case, without going to details, we look at one earnings-based measure sort of takes half of earnings yield as the carry part, and then expected earnings per share growth, which we have historically estimated from historical EPS growth data since 1970, or from and combined it with some consensus forecast on GDP growth, really using what's available, what kind of data we can use to get some meaningful cross-country differences here. And the second one is dividend discount model approach, where we have tried to refine it by including the role of buybacks. So we add here to dividend yields net buybacks, and that means that the growth estimate will have to change somewhat. Again, not going into details, that's available in our publications. But if you just look at the numbers, look at, for example, Switzerland, you can see 3.6% real return and 5.7% real return, and we average those. So that's a big gap actually between them. But so we'll be humble about what numbers one should use, but the ballpark numbers we get for that combo tend to be reasonable. And then what you see in the fourth column is a change since turn of the year, and basically all of these estimates have become higher because equities did cheapen because of COVID, with one exception to the positive changes. In Euro 5, actually it's negative because dividend yields fell so much in April, May. And I guess the intuition here is that policymakers were telling to companies that you want to get our support, you don't want to pay dividends now, or you are not allowed to do that. And so that showed up already in European data in second quarter. Last two columns convert the expected real returns into expected total returns, either on currency hedged basis or unhedged basis. And so in the last column we mark there's Swiss currency return, but actually we assume random walk currency, so that's a 0 effect there. So anyway, so that's the framework and those types of numbers, but pretty benign looking numbers actually, so pretty high. And that's because cash has got such a low expected return. So we are in a world of low total returns, but because cash is even lower, the expected excess returns over cash look pretty plentiful. And I still briefly show on the next page government bond estimates. They are clearly lower, but it turns out that they too are higher than what you could expect from cash. So that's really suggesting that in this situation, taking no risk, staying in cash is very, very costly. Okay, so again, we don't assume any mean reversion. We just say that let's take nominal yield. In this little fancier version, we include the yield curve steepness. We include some roll down return estimate into the expected return, and then we subtract consensus forecast of inflation, and then you can see basically the expected real return for 10-year bonds, which is negative in all cases, but turns out to be higher than cash. And again, these numbers have tended to fall during this year. And finally, we then convert this into total returns. And I'll return at the end of the presentation to the question of Should one hold government bonds at these types of levels? And we will emphasize that, again, they have got higher expected returns in many cases than cash, and they still provide an interesting safe haven service for now anyway. So we do see a decent role for them, apart from regulatory reasons or liability hedging considerations. Next. So this picture here just highlights the 10-year yields across countries, how they first when you look at left, they look very different across countries, but that's really talking about perspective for investors from different countries. For any investor, you have to sort of anchor things to your own cash if you are buying currency hedged investments. So the subheading there tells, in any currency hedged investments, you earn your own riskless rate and the excess return, which in this case depends on yield curve steepness on the foreign asset. And your low cash rate is sort of heavy anchor, takes these things down. So if you look at US investor and US cash in the middle panel there, you can see that US investor can expect positive returns for bonds from all countries, whereas a Swiss investor can expect negative returns related to the heavy anchor that you are facing. Okay, next please. So what can you do? What can you do to keep warm in this situation? And again, I would say accept first part of the reality, communicate it well, but what have been common institutional investor answers? Let's go to the next page. So three most common approaches in recent years have been to take more equity-like risk, add more illiquid investments, and add factor tilts or alternative risk premia. Earlier, like hedge funds were very popular 10, 15 years ago. Now they become somewhat less popular, but that's sort of part of this diversifying return sources in liquid asset classes. Okay, and each of these has got motivation and its own challenge. For equities, it's clearly assuming that there is one reward that you can rely on and don't count on anything else. Believe in the equity premium. That's sort of the Norway approach. I advised Norway for a long time, and they have got this heavy reliance on equity premium. But it's, of course, it is a risk we are already, that dominates many portfolios. Then there's a Yale model, endowment model, which relies on illiquidity premia and maybe the idea that there's a better chance of getting manager alpha in that space. And then the last one is multi-factor beliefs. Some Nordic institutions are pretty big on this one. So evidence on multiple rewarded factors and diversification benefits. If you do that long short, you really need to use some leverage to fully take advantage of it. And I will talk about each of these in the next slides a little more. Let's go to next one. Equities are so familiar that I don't have to talk much about them. I would emphasize that it is the easiest way to take risk. It's a comfortable, convenient way, and that allows investors to be more patient even when you get 10 bad years, which happened in 2000s, it happened in 1970s, of course 1930s, 1910s. So it's happened almost every other decade historically, but in the long run you've been well rewarded. I don't think investors would be as forgiving for virtually anything else than equities, especially given the volatility that they give. So part of that volatility is that many investors in this call have experienced the 250% drawdowns during the dot-com bust and the GFC. So there's a reward, good story behind it, but there's also a lot of risk. Still, definitely important thing to have, but what else can you do? Let's go to next page. So illiquids are very popular, and I will emphasize the work we have done on private equity, in particular US buyouts, where we have got pretty decent historical data. I'll then touch briefly real estate and private equity. And so first I want to tell the positive story. When you look at US buyout history, there's more than 30 years of data, and the industry has outperformed S&P 500 by about 3% per annum in that time. And that's after fees, and that's for the whole industry, not top quartile. Maybe there's some small selection bias, but overall, that's a very impressive track record, and those fees were pretty big ones to beat. But I think for the future, you have to be more cautious. I will show here that the edge has been smaller since 2006, both in an ex post and ex ante analysis. So what I show on the left-hand side is realized return of each vintage. So basically a class of buyout funds that were started at a particular year, first 98 there, and I show measures called public market equivalent. This is academics' favorite way of looking at the outperformance or underperformance of private equity versus some index. So values above 1 mean that private equity outperformed the benchmark, which often is S&P 500, as it is in the top line there. And if you get PME under 1, it means that you have underperformed. And 1.2 means that there was 20% outperformance, and that means that, and that's roughly, by the way, besides being the number for the 1998 vintage, it's also the long run number that tends to come out in literature. 20% outperformance, but that's outperformance over the life of the fund, which tends to be 5-6 years when capital was used on average, and then that translates to close to that 3% outperformance. Okay, but what this picture shows is that most of the outperformance came to vintages before 2006, and since then there's been, in this picture, almost no outperformance. Some updates to this. This is a paper in FAJ a few years ago by Lehr and others. But if you update the most recent data, it would improve these numbers somewhat, but it still tells clearly the story that after 2006, there's much more modest outperformance than before. And the lower line tells that if you don't compare to S&P 500, but you compare to leverage and size and sector adjusted stocks, basically roughly small caps, and acknowledging that private equity has got leverage and of course different sectors, then the outperformance hasn't really been there even over this long period. But I would emphasize just the idea that since 2006 there's been more competitive environment that really coincides with the period where you got first institutional increase in this space. So Yale model became very popular around that time. Many pension funds, besides endowments and so on, came into this space, and that meant that private equity became more important. And you can see on the right-hand side that when you look at the valuations of private equity to public equity, there was a big valuation gap until mid-2000s. And this is noisy data. It's hard to get good estimates on these valuations. You get it only for a fraction of all these deals that are out there. But whenever I see pictures like this, they have got this shape. Details differ, but the big picture is that there was a big valuation gap, and then it narrowed hugely after mid-2000s. And so private equity looks quite expensive, and broadly as expensive as public equity today. Okay, so challenging environment because of high valuations and competition from other institutions, from the big companies and all the dry powder and so on. Okay, next page. And beyond private equity, but also related to private equity, I have emphasized a lot in my writing the idea that private assets have this other feature besides illiquidity. They have this lack of mark-to-market smooth returns, which investors really like. And investors maybe should recognize, okay, so maybe it's good, maybe it is. You can debate. Some people say that it's totally artificial and you should just ignore those raw valuations, just create some sort of de-smoothed or otherwise mark-to-market versions of your private assets. But let's just say that most of us do care and do enjoy the fact that there is some smoothness there. You see my smooth sailing picture on the right, and I'm saying that doesn't come without costs. And I'm saying that for any amount of fair illiquidity premium there is out there. So for example, if we assume that we should require 5% real return for locking our money for, or extra return for locking our money for a decade, we shouldn't expect that we are going to get that 5%. We might get half, we might get more or less than half. It's really hard to tell. The data sucks in this space. But we say that basically decent amount of the fair illiquidity premium is offset by this smoothing service that we like and we pay for. And just for your info, the pictures actually, they show on the left, or well, let's say on the right, this is the Cambridge buyout index over time, over 33 years. And on the left, you see small cap value proxy for it. They end up in the same place. So they gave the same compound return over time, but clearly one of them was much more volatile. And actually, like I like to then say that, you know, look at that last drawdown in GFC, and basically Cambridge index drew down 25% and the public proxy drew down 60%. So that is, you know, that there's in many institutions there would be some likelihood of panicky capitulations, bad behavior if you are hit by that mark to market. So that's the logic why people say that we really like the smoothing, but then if you like it, don't think you are alone and don't think that you get it for free. You will get less of illiquidity premium because of that. But still, that said, by buying private equity, you can, I think, increase your total equity allocations because all the MTM losses don't hit at the same time. So I'm sort of telling something positive, but also telling that there's a cost to this. Next slide, please. So the other illiquids, I only cover very briefly. I say that real estate actually has got even longer histories. There are some attempts now to create even 100+ year histories, but there's a lot of controversy what you should assume there for the rental yields, and so I don't really want to go there. But I'll just tell that that in the US they have got this nice 40-year history of having data both on direct real estate, illiquid real estate, and then liquid traded REITs. And it turns out that REITs over this history have actually outperformed direct real estate. And even if you adjust for leverage and sector differences, you get near zero performance difference, so no illiquidity premium. So really the first-hand evidence of this longest history we have on illiquidity premia in private assets is telling that, well, there actually wasn't anything. And if we look at more current situation, I am not an expert, but I do hear from people who are in this space that actually direct real estate valuations might be higher than those in public listed markets. So it's not clear that you get too much now. And then there are many others, infrastructure and in particular private debt, private credit. And I would say it does have apparently a wonderful history, but that wonderful history over the last 20-25 years is a bond bull market and very little sort of credit. Well, there have been some meaningful credit spread widenings, but even those were relatively short-lived, so the smoothing helped a lot. So smoothing, I should say, smoothing is particularly helpful when you get the V-shaped type of patterns. When you get U-shape, L-shape, W, smoothing won't help perhaps at all. And so that's so if you worry about Japan scenario or anything that's sort of more slower, then don't count that the smoothing is going to come to much help. And do recognize that if you look at some historical episodes, especially this year, but even GFC, the smoothing was particularly helpful, and you can't count that it's always going to be as useful for this for the private assets. Anyway, so I'd be cautious about extrapolating the historical outperformance. It really hasn't been tested, and there are questions on credit quality, whether things have changed over time, whether credit quality is now worse, and whether there are some gaming going on, whether there are selection biases. I'm not enough an expert to answer those questions. Okay, next slide, please. Now I have a few slides then on my sort of favorite answer, but again, I think all of these are part of the menu and this should be considered. So harvesting multiple factors. This picture shows century of data on the return sources where we have seen most consistent risk-adjusted returns. On the left, you see for asset class premia, equities, bonds, commodities, credits over treasuries, and in all cases, there's been some nice positive reward. I show gross Sharpe ratios before trading costs. That's especially important when we turn to the right side, where again, I haven't included trading costs. With trading costs, there would be lower numbers here. But basically, these alternative risk premia, which I explain in a moment a little better. Many of you know them, I think, pretty well. So long short strategies based on some styles have had even higher Sharpe ratios for two reasons. One is, again, I didn't subtract trading costs. And second, because there's a lot of diversification. You can apply these ideas in many different asset classes, and that has been done here, and that boosts Sharpe ratios. But I think even the root story is very positive. And let's go to next page, and I'll just quickly show here the 2010s performance for these series that we were looking at, and I include US equities separately. This picture has got some numbers on 2010s performance, but in particular just the symbols and the y-axis are showing whether 2010s performance was at par with the historical experience, which would be number 1 on y-axis, or whether it was twice better as we see for US stocks or global bonds, or whether it was something lower as we see for many other cases. And then for commodities, you get even a negative return. And so basically it was a very good decade overall for investing, but especially for US stocks and global bonds. And when we look at styles, defensive styles was doing particularly well, and the other ones were giving below average performance. Next slide, please. And yeah, this is really introductory, sort of reminding of these styles. Value, you buy cheap things over expensive ones. Momentum, buy last year's winners versus losers. Carry, by high yielders versus low yielders. Defensive, by the boring stuff. Low beta, low volatility, or high quality compared to more speculative stuff. You can do these things in a more fancy way. You can do them in many asset classes. All of that is discussed in many papers. And on the right-hand side, I describe various explanations, whether risk-based or behavioral explanations that could be behind each of these ideas. I don't go into more detail. I rather show some empirical data still on page 24. Next, please. And this is showing again this century. And I show this only now for value, momentum, carry, and carry defensive. So multi-style long-short strategies based on each of these ideas. And I show Sharpe ratios per decade. And you can see that overall these ideas didn't just only work over the century, but they seem to have worked, at least on paper, over most of these decades. And if you look at, again, the last set of bars, you see something similar as I showed earlier. The star style of the 2010s was the defensive styles. Other ones were disappointing. But this doesn't really show when we look at overall. You don't see too much decline here when we take this package. Of course, last few years have been disappointing. And next slide, please. And I want to finish with this realism, this factor section, by telling that factor investing has suffered in recent years, and the suffering has been led by stock selection value, picking cheap stocks versus expensive stocks. We show here the drawdown history for one variant of this value investing approach, and then at the bottom we show sort of the flip side, which is the ex ante opportunity, then value spread. How cheap are value stocks versus growth stocks? So it's sort of mirroring picture there, and you can see that basically there was a big underperformance and cheapening during the tech bubble. There was another one just before the GFC, and then recent years have been again very bad for value style, and you know, it was painful to get here, but it also looks like an exceptional opportunity now. But so this is obviously a big topic that's being debated. Then has the world changed in a way that this type of picture matters less than it has? We do think we emphasize the opportunity, but we acknowledge the pain and certainly experience some of it. Okay, now I move to the last section, how to protect yourself in a downturn. So this is sort of more on risk mitigating strategies, tail hedging strategies, and we've written quite a bit about this over the years. I'll start by, next slide please, one picture which is of our latest alternative thinking, which compares various tail hedging approaches as when they are overlaid to a US 60/40 portfolio. And we show here cumulative outperformance at different horizons. So the theme was protection fast and slow, playing with the words of Kahneman's book. And what we show then is that option-based approaches have been quite good in terms of returns, and separately we showed hit rates in the publication. So buying out of the money puts, that's good at short horizons, less so at long horizons. You actually start to get pretty negative returns when you look at bad events over very long horizons, whereas many other alternative approaches, style premia, risk parity, trend following, defensive stock tilted 60-40, they have all done better. They are not that, they are not similarly direct tail hedges as option-based approaches are, but they have provided some good diversification, and in some of them also even tail hedging characteristics. Let's go to next page, and I explain why the options have disappointed. So this is something that comes out in a few days. We'll have a paper on contrasting just simply trend and put strategies in tail hedging, and this is cumulative returns at the top of a simple trend following strategy, which has tended to make sort of weirdly good money over history, not so much in the last 10 years when central banks were keeping those trends very short-lived, but still even in 2010s mildly positive in most cases. Whereas put strategies, when we look at, this is now 5% out of the money put strategy for S&P 500, and it's difficult to get deeper out of the money for these early years. So I show this one here to get 87 into the picture, and we've got other pictures looking at deeper out of the money options then, since there's better data in 96. But the big picture basically tells of this long run bleed, which is important. It's interspersed by these wonderful performances then when most needed at some fast crash time. So clearly, index puts can be very valuable when you get those fast crashes, but they can be so painful to wait that it's very difficult for investors to stay patient with them. So we think this bleeding makes it very difficult to sustain these types of tail hedging strategies. That's why we favor the indirect hedges. We also discuss in the paper somewhat the active management performance, scalability issues, all kinds of other questions, but this is sort of the starting point, and this is about long run returns. Next page, next slide please, also shows that both of these approaches, put and trend, have done well in major drawdowns. So we do think logically and empirically there is a pattern that puts are better at fast drawdowns, such as worst months, and then when the slower drawdowns you look at, then the more you see trends doing well because the cost starts to hurt with puts. Actually, these worst drawdowns tended to be either a few months or in the worst case 2.5 years. So it's not you don't get too terrible performance for the put then in this one, as you saw in a slide couple of slides ago. But overall, so my message would be both of these have worked well. Trends tend to do better in the slow ones and put better in the fast drawdowns, but there's sort of a funny little or surprising nuance or result at the top that trend following actually made money in 9 out of 10 worst months in those 35 years, only lost in 1987. And the intuition is that these first months of a bear market don't tend to be the worst ones. So you sort of need an advanced bear market before you get to this really ugly episode. That often happens, but it's not. It need not happen. And again, this time, for example, in February, March, things happened pretty quickly, so that wasn't helpful. Still, trend following ended up ahead, not because of equities, but because the other asset classes gave some profits. So the trend following here is not just equities; it's for asset class trend following. Okay, again, publication in a few days. Last slides. Please, next one, the two on bonds, and this just reminds that bonds have been very good tail hedges still in equity drawdowns in the last decades, working in all of these cases, but before 1990s less so. And next slide, please. So there is a question whether this will continue. Either there's a question, can bonds still deliver something when they are so low yielding? We do think that yields can go negative and more negative if needed. So we don't think that's really a constraint. But there's also this point that what you see in the top line is rolling stock bond correlation. And many of you probably know that that stock bond correlation, while it has been negative in returns for the last 20 years, used to be positive. And the question is, could it turn positive again? And our story is basically that as long as inflation risk doesn't dominate, we think that we are going to have negative stock bond correlation. And I'll quickly tell this story here. So this is because this is sort of important. So equities and bonds are both driven by growth news and inflation news. As long as growth uncertainty dominates, we tend to have bonds and stocks moving to opposite directions, and we tend to get negative stock bond correlation. And that's been a story of the last 20 years when inflation expectations were very stable. But if we get a world where inflation expectations become disanchored and we get more inflation uncertainty, then that tends to hurt both stocks and bonds. It tends to be higher inflation uncertainty, higher inflation, lower valuations in both asset classes. And that's sort of the worrisome scenario for the future if we get more inflation. And I think there's going to be some questions about this. Okay, I think there's a conclusions page, and then we can turn to questions. So I would say all solutions that I have highlighted here should be considered. The low expected return challenge is so big that you don't just pick one of them, but try at least 2, if not 3 of them to enhance your chances of surviving this winter. And then I am happy to take any questions. Next page.
I think one topic most people are really interested in is the whole discussion around inflation and deflation. So first of all, what do you expect in the next years regarding inflation and deflation?
Yeah, well, this gets to the discretionary land, and so we tend to take as our inputs consensus forecasts on these, and they tend to still be for this, 1 to 2% type of inflation. But I'll just put a bit of my old discretionary hat here, having been also in discretionary places before. I think in the next year, as long as we are still in this 90% economy or under precautionary savings mode and so on, you are not going to get much inflation. But eventually, I do think that all the stimulus and so on may have to be compensated. The same idea was out there after GFC. It didn't happen then because we had basically offsetting secular trends from globalization and just-in-time supply management, China effects and so on, besides maybe demographics. And so many of those, of course, globalization, just in time being now just in case, and so all of these types of arguments suggest that we can get really this inflationary outcome. And of course, stimulus is even bigger than it was. So I would say not 2021, but eventually I would personally think that there's a good chance that we do get inflation sometime in 2020s then. And that would be challenging certainly for bonds, as I just discussed. The stock bond correlation would flip. So I would say, bond yields would rise because of higher inflation expectations. They would rise because of inflation risk premium, which has been bid away, and the safe haven premium related to negative stock bond correlation might also turn. And then equities, if we get meaningfully higher expected inflation, that has not been helpful for equities either. So I think you can have that pain happening in many places.
So adding up to this, we have 2 questions from Arno van den Heiligenberg and Eleanor Ockram. Assuming that inflation would go up something like 4 or 5%, how would your return expectation change due to that?
Yeah, yeah, I think so. Well, I was just telling sort of a bearish story, and mechanically for our capital market assumptions, I think it would come through again higher inflation expectations and maybe bond yields then rising, reflecting those wider inflation premia and lesser safe haven sort of advantage then. So it would show up in market prices in our capital market assumptions, and likewise for equities. Again, we don't really. So it would be the idea that we have seen historically that earnings yields tend to rise and equity valuations fall when inflation increases. So if we get to that 4 or 5% inflation, I think both asset classes will have valuations that imply higher expected returns. Getting there means capital losses in the way.
Maybe one add-on question on what could protect us in such a scenario in your view?
Yeah, there's not much in investor portfolios that helps there too much. Like, people often think that real assets by their name have got that, but actually, like many types of real estate are not so related to, they don't give much inflation protection. The more those assets are about capital appreciation, then they like low yields and low inflation environment. And like in 2000s you had, and now you have got high real estate partly because of low yields. To the extent that you have got very sort of short duration illiquid assets, like your rental contracts are updated fast, then that could be helpful. Then you have got inflation protection. But I think many real assets will disappoint investors if this happens. Not just equity, but also many illiquid. So I do think commodities, some basket of commodities can be helpful. Gold in particular, to the extent that it's related to the sort of monetary challenges, but more generally some commodity basket. And then there are, of course, the various direct inflation products. And then there are certain equity sectors and emerging market currencies that tend to be used as potential helpers there. That's pretty much the menu. But most investors should sort of look at their portfolio and ask critically, do we have anything there that's going to flourish in this situation? And that's one reason why I like actually trend following. It's not only hedging equity bear markets, but if we get to this gradual bond bear market, I think trend following will be one of the good things that's going to one of the few good things that's going to help investors in this situation.
Perfect. Thank you very much. And we have a question from Ellen Oberhuber from MainFirst Schweiz. What could trigger a turning point to the low expected returns?
Yeah,
probably adding on again to the first question we had.
Value, cheaper valuations, which can come from external shock, like again another round of COVID could do that. Higher inflation eventually can do that. And I think the thing that of course has been so important, sort of the Fed put and more general sort of stimulus and support that we have gotten from policymakers, when they start to draw limits to that for one reason or another, that can gradually start to hurt asset markets and become basically a catalyst then for higher expected returns in a not nice way. It comes through pain and suffering, basically, blood, sweat and tears.
Then from Mr. Achermann, do lower expected returns go along with lower volatility? Meaning, can we still expect similar risk return opportunities?
Yeah, I think maybe somewhat lower volatility, though we didn't see that obviously in the first quarter. But I emphasize like that sort of led to the question on sort of Sharpe ratios, so risk-adjusted returns. And so there's volatility, and then there's dividing by volatility, but there's also subtracting cash. And again, so the cash is so expensive now. Cash is the negative expected returns on cash make any other investment look good. So the ex-ante Sharpe ratios we see for many investments look better than historical normals, even though we say that we have got low total expected returns on everything. And so if investors care about their total returns, they should be sort of worried and prepared, even though those risk-adjusted returns and excess returns over cash may look attractive.
Yeah. Then we have a very interesting question from Frederick Lebel. What do you advise pension funds to do, taking into account such low real expected returns? Can alpha be a source of performance?
Yeah, and it depends how you measure alpha. So if we say, I listed three things there. So I said more equities, that wouldn't be alpha, but illiquids and these alternative risk premia certainly are considered alpha versus capital asset pricing model or one factor model. So I think both of those are answers. And then other possibilities, sometimes other alpha then can be more discretionary stock picking or market timing. And I would say that there the evidence is not as good as for the two things the illiquid privates and for the alternative risk premium that I've highlighted. It's more a faith-based decision than that you can pick those superior managers and they can be worth their fees.
Thanks. Then we have a question. I mean, you're speaking about momentum and trend, and there's a question: how do you distinguish the two, and how is the outlook for the two relative to each other?
Yeah. So this is I rushed through that part, and it's always helpful to clarify that. So all the four first styles I talked about: value, momentum, carry, and defensive, were meant to be market neutral long-short strategies. You always try to be market neutral, also now in momentum. Whereas trend following embraces market direction. So if we get a very bullish year like 2019, at the end of that year, when all risky assets went up, trend follower says that, oh, I will buy all risky assets because I look at each of them and they all went up. And so I will go long beta in a big way. I embrace the directionality. Whereas momentum says that I will buy the things that went up the most, but I have to sell the ones that went up only a little, and I don't take any market directionality. So that's the distinction. Momentum tries to be market neutral. It turns out both of them have historically done reasonably well, but the safe haven characteristic or the good tail performance that I highlighted earlier is actually pretty exclusive or more specific to trend following. So embracing directionality. So basically saying that if we are in a risk-off environment where equities have recently fallen, then probably also bond yields were falling and gold was outperforming other commodities and anti-carry currencies were doing well, you put on these risk-off positions in all asset classes and you ride them. And as long as you have got a sustained bear market there, you'll do well. So trend following embraces that outcome. Momentum captures more market neutral versions of the same thing and not these directional parts.
Now we've covered large parts of that alternatives universe. I think one part that is missing a bit is the discretionary space. So for example, global macro managers. How do you see those? Are they complementary to the more systematic space and trend and risk premia, or what's your outlook on those?
Yeah, I think they can be. In general, I guess I like discretionary more in the places where they are still relatively uncorrelated with the market, so that you are not paying your alpha fees for beta performance. So macro, but systematic macro has also done well recently. But I think discretionary macro, certain discretionary macro managers can be very good, and we saw that again this year. Like one of my old employer used to be particularly good at this type of thing and has shown again its mettle in this situation. And some of them can handle these types of risk aversion spikes particularly well. I think they are, together with trend followers, interesting candidates then for this situation. Separately, then other types of discretionary, I'm sort of personally then less hot on the discretionary stock picking and some other approaches, but that's personal.
We have a number of questions regarding the value style. What are your expected returns for that? And are there maybe also logical reasons for the underperformance? So might there be more obsolete assets in value at the moment, or maybe also in the last couple of years, that might explain the underperformance?
Sure. So first I refer, like we have written a lot about it, and so Cliff's blog and a paper, Is Systematic Value Dead, cover lots of these issues. So we certainly we try to go through all the questions that have been raised. I think the most plausible one seemed to be this idea of disruptive companies being so popular. So sort of starting from the FanMags and so on, and then Cliff's recent analysis then basically showed that you can take away from the universe all these kind of the richest companies or the TMT sector or the largest cap companies, and you still find sort of similar patterns that the value both has done poorly and looks particularly attractive in this situation. So sort of the story that struck most plausible to me was sort of shown not to be, maybe there's some of that, but that's not the only one. It seems to us that really people have taken this idea of disruptive companies and run as usual too far with that. So we do think that we are sort of in a published territory with value versus growth, and the opportunity is good. When the turning point comes, it's really difficult then to say, and it's very frustrating, and it has lasted long. Another important story that has been raised has been related to interest rate levels, and there's something to that, but we find that even that type of or impact on yield level or curve steepness can have some impact, but it's not big enough to explain most of what's been happening. So overall, we believe in the long run story, the strategic story, and we believe that despite the pain, tactically, it's particularly attractive right now. And to that question on obsolete, we've tried many other metrics. Like it's easy to criticize book to price because it's so outdated. But we've looked at many other metrics which are more forward looking, and the stories are not meaningfully different with them. So I think however you look at value has suffered and value looks attractive today. It's a matter of your belief then on whether, in some sense, are you inherently contrarian or pro-cyclic or a weak believer or a strong believer in these strategies, whether you are going to stick with it or even raise or capitulate.